So topic number 1, that is advanced financial reporting and analysis. Topic 1. So topic 1 is assets and liabilities. Assets and liabilities, assets and liabilities, assets and liabilities. And I will start right away with the first item, which is IFRS 2. IFRS 2, IFRS 2. This is what we call share-based payments. So a liability accruing out of what year? Those shares or share options that we make promises to our employees. You tell our employees that if you guys work for us, for example, for 4 or 5 years, then we shall be able to give you the company's shares. It's a liability we are creating. We must pay them. You must pay them. So IFRS 2, share-based payments. I have some notes here which I'll be able to share with you after the class. So please, the most important thing is for you to be attentive here. That is the most important thing. You just need to be attentive. So in this case here, what is our agenda? What is our agenda for the class? What we shall be discussing today, we shall be looking at this IFRS 2 called share-based payment. And we've got 2 types of share-based payments. We have those share-based payments which will be settled through equity, where we shall give you shares of the company. We call them equity settled share-based payments. And then we have number 2, what we call cash settled share-based payment transactions. So by the end of today's session, all of us would have understood that in terms of this IFRS 2, we have got IFRS 2 share-based payments, share-based payments. We've got what we call equity settled, and then number 2, we have what we call cash settled, share-based payments. You can take your notes. So we have equity settled, share-based payment, share-based payment, share-based payment, share-based payment, share-based payment, share-based payment. And then we have in this case here what we are calling a cash settled share-based payment. So equity stands for what here? Basically shares. So here we shall be able to give you ordinary shares once in this case here the period we agreed comes to an end. We agreed you work for us for 4 years, you worked for us for 4 years, then we shall be able to give you what we call the company's ordinary shares. And the cash settled the share-based payments, this one here we normally use what we call share appreciation. Share appreciation rights. The share appreciation rights. The share appreciation rights. What we shall be abbreviating popularly as SAR. Share appreciation rights. The share appreciation rights. Share appreciation rights. So well, then what does this mean? This means that if it is RCM College, we are telling you that you guys work for us. And by end of the year, for example, like they do for these big banks like KCB, for example, Cooperative Bank, they tell you that currently our shares are selling at shillings 5. Come end of the year, if our share value appreciates, if our shares in this case here price appreciates, for example, to 8, then in this case here we shall be able to give you some bonus. We are not going to give you money here. We're not going to give you shares here. We shall give you money. We shall give you bonuses. But this bonus is based on share price, share appreciation. So basically here we are giving you ordinary shares, and here we are giving you a bonus, cash bonus. We shall give you bonuses here. We shall give you bonuses there, cash settled, share-based payments. So then the question that will be able to arise here is, if you're going to give us cash, why are we accounting for this under share-based? It's because the bonus we are going to pay you is pegged on share price. The bonus we're going to give you is pegged on what here? Share price. Is pegged on share price. Now, please listen and listen to me very well. Listen and listen to me very well. We are told here, under the introduction, that share-based payment schemes have become increasingly common. A share-based payment occurs when an entity buys goods or services from employees, for example, buys goods or services from other parties, such as employees or suppliers, and then number one, settles the amount payable by issuing its shares or share options. Or number two, incurs liabilities for cash payments based on what year? Its share price. Incurs liabilities for cash payments. You shall be paying them cash based on its share price. Now, please listen and listen to me very well. We have just mentioned there, and we are iterating again, that we have got IFRS 2 applies to all share-based payments. There are two main types. Number one, we have equity settled the share-based payments. The entity acquires goods or services in exchange for equity instruments of the entity. We are going to pay them, ladies and gentlemen, using shares or share options. That's what we call equity settled. And then we have a cash settled, a share-based payment. The entity acquires goods or services in exchange for amounts of cash measured by reference to the entity's what year share price. I would want, ladies and gentlemen, to repeat this once and for all. We are saying something very important under IFRS 2 share-based payments. We have got two types of share-based payments. We have those share-based payments, which at the end of the day will be settled using equity. Equity, we are looking at you giving those guys ordinary shares or even what we call share options. Or we have got those types of share-based payments where at the end of the day, we shall end up giving what we call bonuses or cash. Cash, which is pegged on how aggressive the management is in terms of driving the share price. If the share price goes up, then automatically shall be able to give you some bonus there. What we are calling the share appreciation rights, SAR. Now, ladies and gentlemen, please, I would want you to add something here. If it is equity-based, in terms of valuation, valuation of this obligation, in terms of valuation of the obligation, if number one, it is equity share-based payment, equity share-based payment, then the obligation here, the obligation is valued on the basis of fair value at grant date. So the obligation for the firm will be valued on the basis of fair value at grant date. The day one fair value. This day one fair value will not keep on fluctuating from year to year. So this figure will remain, the figure remains the same. The figure remains the same over grant date. It remains the same over the grant, or rather over the vesting period. It doesn't change, i.e. it doesn't change. 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 So if it's equity share-based, equity settled or equity share-based payment, then the obligation is valued on the basis of fair value as at the grant date. And this figure will remain the same over the vesting period. Over the vesting period, it doesn't change. It doesn't change. And then now we have got a cash settled or cash. So number two, we have what we are calling cash settled. So for cash settled, share-based payment, the obligation is always based on fair value at the end of each year. At the end of each year, i.e. the fair value will keep on changing. The fair value will keep on changing. The fair value will keep on doing what here? Changing. The fair value will keep on changing. The fair value will keep on changing. So something very important for us to appreciate from the word go. And the moment you have known this, we have basically understood the entire standard. We have understood the entire standard. So if it's a share-based, if it's what you're calling equity settled, always the fair value will be the fair value as at the grant date. But if it's cash settled, then cash settled, because of the appreciation concept, shares appreciating at the end of each year, we expect these guys to push them. We expect to push them that the share price at the end of each year should be increasing. Then to motivate them for purposes of valuing our obligation towards them, then we shall be using the fair value of those shares at the end of each year. And of course, we expect that fair value to keep on doing what year? To keep on changing. Now listen to me very, very well here. What are the journal entries? For this obligation, what are the journal entries? Journal entries. So in this case here, journal entries, the journal entries that we shall pass here, we shall come under debit, ladies and gentlemen. We shall come under debit. In this case here, we have, we shall come on debit. We have in this case here an expense. So we have the expense there. So this expense, of course, we shall call it the staff cost. So go under what we call the staff costs. And then we shall come under credit equity. Remember this equity, it will go under what we call other components of equity. Write this in full. Other components of equity. Why are we crediting equity? Because we are giving these guys shares. We are giving them shares. So we shall credit what we call equity under the statement of financial position. It will go under what we call other components of what here? Other components of equity. And then, of course, if it's cash settled, we shall come under credit what here? The cash that we are paying them. So this is very, very important. It depends on how you're doing your settlement. You're going to give these guys shares, then it is equity that will be increasing. We credit equity. And of course, if it's cash you're giving them, then the company is paying out cash. We shall credit cash like that. So then we shall do now questions. Before I look at a past paper question, let's look at this question that I have here, which I would expect you guys to screenshot. So this question It's called Test Your Understanding 2. Test Your Understanding 2. Test Your Understanding 2. If possible, please take a screenshot of this question. It's an important question, yes. It's an important question, yes. Please take a screenshot of that question. Take a screenshot of that question, please. Take a screenshot of that question. Great. Great. Test Your Understanding 2. Equity settled, share-based payment. Equity settled, share-based payment. Great. So you're told there, an entity has a reporting date of 31st December. So 31st December is when we report. On 1st January 2021, it grants 100 share options to each of its 500 employees. Each grant is conditional upon the employee working for the entity until 31st December 2023. At the grant date, the fair value of each share option is 15. During 2021, 20 employees leave the company, and the entity estimates that a total of 20% of the 500 employees will leave during the 3-year period. During 2022, a further 20 employees leave, and the entity now estimates that only 15% of the original 500 employees will leave during the 3-year period. During 2023, a further 10 employees leave. So they want us to calculate the remuneration expense that will be recognized in each of the 3 years of the share-based payments. Ladies and gentlemen, the first thing that you need to recognize is that what promise have we given these people? We haven't told these people that when the share price increases, we're going to give you cash. We have told these people that we shall give them 100 share options. We are going to give them equity instruments. Here we are told we are going to give them equity instruments. We are told here we are going to give them equity instruments. It grants 100 share options to each of its 500 employees. So this is an equity settled share-based payment. And if it's an equity settled share-based payment, then, ladies and gentlemen, what I will have to look at as at this date we are granting them this promise. What is the fair value? What is the fair value as at this date? And we are told here at the grant date, the fair value of the option is 15. This is so important. So over the 3 years, these are 3 years, by the way. Over the 3 years, I'll be using 15, 15, 15, 15 for valuation. If it's equity settled, the time when we were making a promise about giving these shares, the price that was existing was 15. And I shall die with that price of 15 till the end. I shall die with that price of 15 till the end. Because this is equity settled, it's not cash settled. If it's cash settled, then the fair value at the end of the year will always do what year? Will always change. Ladies and gentlemen, remember here, we are told on 1st of January 2011. It grants, in this case here, these guys 100 shares for each of its 500 employees. Each grant is conditional upon the employee working for the entity until 31st December 2023. So we're looking at these guys working for us for the whole of 21, working for us for the whole of 22, and then working for us for the whole of 23. So those are 3 years. Those are 3 years. So you must, in this case here, work for us for 3 years for us to be able to give you the company's shares. Here we are looking at longevity of service. Would want you to serve us for many years. Would want you to serve us for many years, for 3 years. So then what do I do really here? These are very, very easy things. So what I'll need to do is to come and make a small schedule here. So we make a small schedule here. We make a small schedule here. So we have got our years. We have got 2021, 2021, 2022, 2023, like that. So in this case here, of course, the guys who are going to get these share options will be the employees who will be left in the company. The employees will be left in the company over the 3-year period. Remember, we began with 500. We began with 500. Remember, we began with what year? With 500. We began with 500 employees. So we want to know at the end, or rather, I'm making my estimates. So when I'm in 2021, how many employees will be left behind working for us? How many employees will be left behind working for us? So come here and read this. So you're told here, on 1st January 2021, it grants 100 share options to each of its 500 employees. Each grant is conditional upon the employee working for the entity until 31st December 2023. At the grant date, the fair value of the option is 15. During 2021, 20 employees actually leave. And the entity estimates that a total, when they use that word total, even that 20, those are 20 employees who left are within that total. And a total of 20% of the 500 employees will leave during the 3 years. So basically, in this case, ladies and gentlemen, we expect 20% to leave. 20% to leave. So they use the word total 20%. So even the guys who have left there within these 20%. So don't subtract them. So in this case, ladies and gentlemen, the employees will wear the vest. The employees will be able to benefit here. Out of these 500, you're told 20 will leave. So shall be left with the 80%. 80%. That 20 which actually left in the first year, I shall be making use of the actual number that leave on the very last year. So I've seen students making mistakes. They'll come and say here times 80, and again they subtract 20. So if they subtract 20 here, they'll be double counting. Because you see, it's a total for the 3 years. For the 3 years, a total of 20% will leave. That's according to our estimate. All right. Now, what about year number 2? Year number 2, in this case here, how many guys do we expect will remain behind? In year number 2, how many guys do we expect to remain behind? So you're told here, during 2022 now, a further 20 employees leave, and the entity now estimates that only 15% of the original 500 employees will leave during the 3-year period. During the 3-year period. And you can see they're making use of the word total, 15%. And the entity now estimates that only 15% of the original 500 employees will leave during the year. So if 15% is leaving, then what percentage in this case will be left with us in the company? What percentage will be left with us in the company? If 15% will leave, what percentage will be left with us in the company? What percentage will be left with us in the company? 15%. Remember, they're not telling you it is 15% of the total, 15% over the 3 years. So 85% will be left with us. 85% will be left with us. Then we go to the last year. The last year is so special to me because I know the last year is where I adjust the actuals now. The last year we work with actuals, we don't work with estimates because now we have the figures. Now, ladies and gentlemen, please listen here. The last year, what have they told us? So they're telling us here, during 2023, a further 10 employees leave. So then what I'll do for the year 2023, given that this is our last year, I will look at how many did leave in 2021. So the actual that left in 2021, ladies and gentlemen, here we were told were 20. So 2021, we lost 20 employees, so minus 20. 2022, we also lost 20, but my memory serves me well. Yes, 20. And then now we have 10 leaving. So minus 20, minus 10 like that. Minus 10 like that. So the last year, we normally make adjustments in the last year, adjustments for the actuals that left in each year. of the actuals that left in each year. Now, ladies and gentlemen, having gotten these employees who are left, then I should be able to know the full obligation, the obligation. How many options do we promise these guys? We did promise them 100 options. Each one of them, the ones who will be left behind, were promised 100 what year? 100 options. And do we know the value of one option? Because I want to get, in this case here, the total obligation. Do we know the value of one option? Ladies and gentlemen, one option, the fair value as at the grant date, which will not change. The fair value as at the grant date will be 15. The fair value as at the grant date will be 15, 15 like that. So this 15 doesn't change because this is equity settled. This is equity settled program. It's equity settled. It's equity settled. All right. Now there is one thing that you're supposed to appreciate. Remember, we shall accrue this obligation on the basis of the years that these guys have worked for us. By the end of this year, these guys would have worked for us 1 out of 3. By the end of this year, any guy who is patient with us shall have worked, in this case here, for us 2 out of 3. 2 out of 3. Of course, this being the last year, any guy who remains behind who is now going to vest this, who is going to wear the vest, would have worked for us for 3 out of 3 years. Out of 3 years. So then could you kindly give me this total obligation? Is there anybody who is able to give me this total obligation? Total obligation. Is there somebody who is able to give me this total obligation here? Please give me the total obligation. Give me the total obligation. And then you shall come and give me what you call a column for expense. You shall give me a column for expense. Total obligation. So you take 500 times 0.8 times 100 times 15 times a third, or divided by 3. Divided by 3. Divided by 3. Who is able to give me this figure really? So according to Sam, is getting 200. Who is telling me the truth? Cole is getting 400. Total obligation. 200,000. Please, Sam, check again. 1.3 million. How? 500 times 0.8 times 100 times 15 divided by 3. Should be 200,000. How about the second one? How about the second one? 500 times 0.85 times 100 times 15 times 2 over 3. The second one, according to Samson, it is 212,500. It is 212,500. How about the last one now? Open your brackets nicely. 500 minus 20 minus 20 minus 10. You close times 100 times 100 times 15 times 3 over 3. The last one. The last one. How about the last one? How about the last one? $225,000, all right? Is that the last one? Is that the last one? Is the last one 225,000? Is that the last one? Is that the last one? Check nicely. Check nicely. Check nicely. Check nicely. You guys are giving me totally different figures. I don't know why, but you're getting totally different figures. You're getting totally different figures. I don't know why. I don't know why you're getting totally different figures. Second is 425 and 675,000. Second, I'm being told that the second is 425,000. And this is 675,000. 675,000. 675,000. All right. So remember, here we are beginning. We made this promise this year. We are beginning from the scratch. And the total obligation in this case here is 200,000. So from 0 to 200,000, So basically the expense to recognize as staff cost in the year will be 200,000 here. First year, you recognize the whole of it. But the second year now you will recognize the increase, isn't it? So the second year you recognize the increase, which will be 425,000 minus what you have recognized here. You recognize the difference. You recognize the difference, which in this case, ladies and gentlemen, will be equal to who? It will be equal to who? Can somebody give me this figure here? Mm-hmm. 425,000 minus 200,000, that is 225,000, like that. 25,000, like that. So remember, we're basically beginning from zero. So the first year you recognize 200,000. The second year you recognize this difference there. That's difference there, which is this. The third year you shall recognize this difference, which will be 675,000 minus this 425,000. Minus 425,000. So 675,000 minus 425,000 gives me what figure? 675,000. So this gives me 450,000. 450,000. Thank you very much. So of course, when I go to the statement of financial position, I expect to see these figures there. And because we shall be paying them using shares. Because we shall be paying them using shares, I shall expect to see this under equity. I shall expect to see this under equity, specifically what we call other components of what here? Equity. Other components of equity. Other components of equity. I'm being told it's 250,000. Thank you very much. 250,000. And then, of course, this is what I expect to see in the P and the L under staff costs. Under staff costs, that's what I expect to see there. Under staff costs, that is what I expect to see there. Under staff costs, that is what I expect to see there. Any question, ladies and gentlemen, regarding whatever you've done? Any question? So when I send you these materials, you need to know that there are answers at the back. There are answers at the back. You must always go and look at those answers. Very important. Very, very important. So like this test your understanding to the back here. So at the back here, you'll be able to see this answer. Like now at the end of year one, you can see at the end of year one, they're basically recognizing what year? 200,000. The expense to increase like that, together with a corresponding increase in equity. And then end of year two, what do we have? End of year two, the expense will be 225,000. That 225,000, like that. 225,000. And then end of year three, you can see in this case here, they have the 200 what year, the 250,000. 250,000. End of year three as the expense. And then, of course, the extract, which you examine nowadays is crazy about. We always ask you about the extract in the income statement. So like in the income statement, the statement of profit or loss, you can see the staff cost for 2021 is 200,000, 225,000, 250,000. And then, of course, we have statement of financial position, other components of equity. We have 200,000, we have 425,000, we have 675,000. You don't need to write them in horizontal format like this. The moment you just finish writing like this, so your extract, this basically becomes your extract of the statement of financial position, other components of equity, 200, 425, like that. And then P and L, staff costs every year. You're done like that. So can I go to a different question? 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 Okay, great. So shall I go to our part paper, November 2016. November 2016. We shall go to November 2016. We shall go to November 2016. I have it here. In 1 minute, it's opening. November 2016. Great. November 2016. It's opening slowly. It's coming up. Give it some time. It's taking forever, but be patient. Patience pays. Yes, there we are. Great. So PDF expanding this is very easy. So it's November 2016. November 2016. November 2016. Question number 4C. November 2016. Question number 4C. Question number 4C. Great. Great. So we are told as part of its staff motivation program, Better Limited decided to grant each of its 600 employees 100 options to purchase the company's shares effective from 1st April 2016. These options were conditional upon one still being in employment as of 31st March 2020. The following additional details were provided with respect to the scheme. The fair value of the option was 25 as at 1st April 2016. The exercise price of the option will be 12, and the par value of the company share is 6. The average market price of the shares over the 4 years to 31st March 2020 is expected to be 25. So they're giving you a lot of numbers there to confuse you. A lot of numbers. You can even see that we have got fair value of each option at the end of each. They're giving you a lot of numbers to confuse you. But what I need to know is what type of share-based payment is this? Is it cash settled or equity settled? So if I'm told that these employees will be given shares at the end of the day, if I'm told that these employees will be given share options at the end of the day, then I know that this is equity settled. And if it's equity settled, then I will stick with the fair value as at the grant date. Peke yake paka mwisho. I will stick with the fair value as at the grant date to the end. So like, what is it that these guys are promised to be given? We are told as part of its staff motivation program, Better Limited decided to grant each of its 600 employees 100 options to purchase the company's shares. So we're giving them shares. We are giving them options. We are giving them what we call equity instruments. And if that is the case, for purpose of obligation valuation, I'll only look for the fair value as at the date when I was granting them these options. And these options, you can see they were being granted on 1st April 2016. This is the grant date. The date of the promise is 1st April 2016. We are told the fair value of the option was 25 as at this date. So this 25 is what I will die with. All these other values given here, price, share price being given here, they are hot air, useless. They simply want to confuse me. They simply want me to fail this paper. All right. So then I would want somebody to look at this date. 1st April 2016. This is when we made the promise. And these guys are going to be given these shares on 31st March 2020, when in this case here, those ones will be still with us in employment by that time, right? That's when we shall be able to give them the shares. So can somebody in this case here give me the number of years? The number of years between the grant date and what we call the vesting period, and they will wear the vests. So grant date 1st April 2016 to 31st March 2020. How many years do we have there? 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 So we have here, this is even counting for me, 1st April 2016. 1st April 2016. So then we have 1st April 2016 to 31st March 2017. So we have 31st March 2018, the second year, 31st March 2019, the third year, 31st March. So those are 4 years, 4 years in total. Those are 4 years. So it's always important for you to know what we call the vesting period. You must stay with us for 4 years to wear that vest, to get a promise. You must stay with us for 4 years. If you miss out on the number of years, you'll get a 0 in the entire question. So then, ladies and gentlemen, what we shall do is to have our years there. We have our years like this, our years like that. And then I would want to be given number of employees to be left in the company. The ones who will be able to benefit in the company. Remember, we began how many guys? 600. So it's good to have the number of guys you begin with, 600, being retained throughout, and then you simply knock off. The guys will be leaving the company. The guys will be leaving the company. Great. So then we are told here, the number of employees expected to terminate or leave employment. Like this was a very easy narration. There doesn't have those percentages. So like the first year, ladies and gentlemen, we expect how many? This is quite straightforward. The first year they expected to leave are 25. So simply take 600 minus 25. 600 minus 25 for the first year. So this one is like, they simply have given you the actuals. Yours is to deduct and deduct and deduct to the end. All right. So when you go 2018, we expect 15 to leave. But remember, you have decided in this case here to retain, to start with 600. To start with 600. So if 15 leave in the second year, then I have to remember that I lost this 25 here. So 600 minus 25, because they have given us like the actuals for each year. So, and I want to account for the number of employees that I will be left with in the company. So go to year number 3. So when I go to year number 3, I must remember the guys, first of all, who left in year 1. I must remember the number of guys who left in year 2, minus now the number of guys who will be left in year 3. This was a straightforward one. It doesn't have any complications. So like in this case here, the guys we expect to leave in year number 3 are how many? They've told us here, 10, 10, 10, 10. So we have here in year number 3, 10. So again, you go to year number 4, the last one, will be minus what we lost here, minus what we lost there, minus this, minus we expect to lose 10 again there. So from there, you come and value the obligation. How many shares were we promising each of the employees will be left with us? Again, 100. 100. So when you do it this way, you will have gotten what we call the number of shares. And I would want to value this. So the question is, have they given me the fair value as at the grant date, which I'll have to die with? Have they given me the fair value as at the grant date that I'll have to die with? Fair value as at the grant date. Fair value as at the grant date. Somebody talk to me. Have they given me the fair value as at the grant date? Have they given me the fair value as at the grant date? 25. Thank you very much, Ellen. And remember, because this is share-based, you're giving them options, the 25 will not dance. The 25 will be static. The 25 will be static. It can't dance. That 25 is so poor, just like accountants. Accountants take accountants to any dancing floor. They don't know how to dance. They can't move their feet. Very few accountants know how to dance. Very few. I've never seen any myself. And I've met several of them at ISPAC meetings in Mombasa. I've never seen even a single one. But again, you can't blame them. So remember now here, there is the concept of what here? Pro rata. Number of years that these guys have worked. So the first year, these guys, of course, by the end of the year, they would have worked for us for 1/4, for 2/4, for 3/4. And then we have lastly for 4/4. So could you kindly give me these figures? I hope they are beautiful figures. 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 So you take brackets, 600 minus 25, you close brackets times 100 times 25 times a quarter. Times a quarter. What do we have there, somebody? What do we have there, somebody? What do we have there, somebody? Okay, so according to Grace, it's 421,875. 421,875. 421,875. Can someone else in this case here confirm that figure? Can someone else confirm that figure? Can someone else confirm that figure? Oh, Abraham has given me a different figure. 359, 359, 375. 359, 359. Let's check again. 359, 275. 359, 375. Thank you very much. So how about the second one? The second one, you open brackets nicely. 600 minus 25 minus 15, close, times 100 times 25 times 2/4. Times 2/4, according to this in Googie, 700,000. 700,000. 700,000. Someone else should be able to confirm figures. I always work with the when two answers in this case here happens to be the same, then automatically we say everything is okay. 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 700. Thank you very much. How about the third figure? 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 So this gives us 1031,250. 1031,250. 1031,250. And then the last one. And then the last one. The last one. The last one. What do we have? The last one. The very last one. The very last one. 1350,000. When I'm doing these questions, I'm able to know whether I'm correct or wrong. In most cases, when you start realizing like the first figure is 359, and then the second figure is 200,000, you start realizing this thing going down or fluctuating in a funny way, you know straight away you are wrong. So come and give us the P&L expense. P&L expense, are you able to get the P&L expense very fast? I'll always start from this. I'll always know this is 0 at the very beginning, there's 0. So I know the first one, I'll take this minus this, which will give me 339, 370, the increase. So the second one, I'll take this minus the increase, basically. The increase, this minus the increase. The increase. So this minus this gives me what figure? According to Auma, 346.25. 346.25. And then the third year, simply have it growing. You simply have an increasing. That increase is what you take the P and L. Expense as your staff costs. Expense as your staff costs, as your staff costs, as your staff costs. So like if you're a very bright student, today when you go to your workplace, because I'm so sure most of you have been handling income statements, you've been handling, in this case here, statement of financial position at your workplace, and you've never known that some of these things are accounted inside there. If I were you today, I'll go to the balance sheet of my company, and I can even ask my boss, the director of finance, where are the staff costs for IFRS 2? All right. Once he shows me staff costs for IFRS 2, I'll ask him whether he has under equity other components of equity, where he's booking those obligations for what your staff costs, because they are obligations, you have to pay them. But because you're paying them in form of shares, it has to go under what we call equity, like that. And then that guy will even promote you, because they'll know that now this guy is a serious guy. If you're able to look for those kind of items in the statements. These guys haven't yet given me this difference, or promotion is never done like that. Maybe somebody may tell me that promotion is never done like that. 331, 250, 331, 250, 331, 250. And then lastly, we have this minus that. The last one, 318, 200, 318, 750. 318, 750, like that. So if you have time, should they tell you, for example, give us extracts of the statement of financial position, P and L. So these are basically the I can even come and write for them if I have time, although I don't like writing like that. Extract of what year statement of financial position. So we have the year 2017, we have 2018, 2019, 2020. So simply copy the figures the way they are given there. So we have here other components of equity. Other components of equity. So we have here 359, 375. We have here 700,000. We have here 1031, 250. And we have here 1350,000. That is it. And then we have the extract income statement, the extract P and L. Extract means part of it, part of it. So we have what we call the staff costs for those same years. So we have 359, 375, we have 340, 625, we have 331, 250, we have 318, 750, and then of course you are now very okay now. Now you're very okay. Extracts are down there. So can I go to something different? I hope you guys are following. 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 $318, $750. Okay. Great, great. So can I go to something different? Even if my numbers, I'm so sure my numbers here could be wrong. Fine. The most important thing is that you guys are able to appreciate the concept and you can be able to run with it in an exam. So I'm waiting for you to give me green light to go on with another question. Ah, great. Great. Lista Uma has spoken there. Mwalimu, you can proceed now. Great, great, great. Now, from there, ladies and gentlemen, then I'll be able to go to a different field. I hope they're able to see my Word document. I hope they're able to see my Word document, of which I would want to take them straight away. Of which I would want to take them straight away to this last thing now here. The last thing, cash settled. You can write there cash settled, share-based payment, cash settled, share-based payment, cash settled, share-based payment. It's here. Cash settled, share-based payment, share-based payment. You can screenshot this question. Please screenshot this question. So you're told an entity has a reporting date of 31st December. On 1st, 2021, the entity grants 100 share appreciation rights are not the same as options. They're not the same as shares. They're given share appreciation rights to each of its 300 employees on condition that they continue to work for the entity until 31st December 2023. During 2021, 20 employees leave. The entity estimates that our further 40 will leave. This is like a tongue twister. Those tongue twisters, if can tie, a tie. If can tie, and untie, a tie. Where can tie and untie a tie? No. We'll go to understand this. So you're told here during 2022, 10 employees leave. The entity estimates that a further 20 will leave during 2023. During 2023, 10 employees leave. The fair values of a share appreciation right at each reporting date, because this is that right that we're giving our employees, that should the share appreciate, we shall give you a bonus. Share appreciation rights are a bonus-based kind of payment. So here you can't tell me that you look for fair value as at the grant date. You can't work with fair value as at the grant date. No, we refuse that. All right. Then they are telling us, ladies and gentlemen, the fair value of the SAR at each reporting date is shown below. So we have 2021, 2022, 2023. So they want us to calculate the expense for each of the 3 years of the scheme and the liability to be recognized in the statement of financial position as at 31st December for each of the 3 years. So basically they want those extracts. Now, ladies and gentlemen, I would want you guys to do me a favor. Just write those 3 years. We have 2021, 2022, 2023. And then what I would expect you to do for me is just to give me a column for the number of employees to be left in the company. Once you're able to do that, then I know you are a genius. Once you're able to do that, then I know straight away that you are a genius. Number of employees to be left in the company. So I have 2021, 2022, 2022, and then we have 2023. So we have here a number of employees. After now doing this number of employees, then you guys will be very comfortable. Once you understand how to get those number of employees, then you guys will be extremely comfortable. Number of employees left in the company. I'm giving you exactly 3 minutes. I'm giving you exactly 3 minutes. Edith tells me to 80, to 70, to 60. Let's see. One thing that I can guarantee you is that the 260, the last one is correct. The others I'm not very sure. Or rather, the first one, let me see. Let me see. The last one is correct. Let me get answers. I would want students who are very, very, in this case here, brave, like Edith here. You give us answers, even if you get it wrong, so what? Even if you get it wrong, so what? Let's see. Great. Please continue making contributions here. Continue making contributions. Continue making contributions. Continue making contributions. Don't fear getting it wrong. Don't fear. Even if you get it wrong, so what? That's life. Life should be full of mistakes. I'll not proceed until I get like 3 of you putting down their suggested answers, like 3 of you. Like 3 of you. 280, 270, 260. Let's see. I'm waiting for one more. Also Grace has given me to add. Grace has different figures. Grace has different figures. Faith has different figures as well. Great, great. Let's mark for ourselves. Please, let's mark for ourselves. These are the answers. These are the correct answers here. These are the correct answers. So the first one should be 300 minus 20 minus 40. So the first one should be 240. Ingine mepotea, I think convert kitabu. 300 minus 20 minus 10 minus 20. I don't know how many will those be. And then the last one, of course, is 260. So that would mean that all of us are wrong, isn't it? That would mean that all of us are wrong, and I can't blame anybody really here. Because there are 3 types of scenarios that you must understand for you to be able to pick how to get number of employees. The moment you get number of employees, every other thing will remain okay. So what have they told us? At least everybody, there is nobody who got it wrong here. At least everybody knew that we are starting with 300 employees. At least everybody knew that we are going to calculate this from 300 employees. At least everybody. At least everybody. And then minus, minus, minus. So then we go and read slowly. You must read slowly. You must read slowly. What have they told us, ladies and gentlemen, about? What have they told us about 2021? So they're telling us in 2021, 20 employees leave. And then the entity estimates that a further 40 will leave in 2022 and 2023. Remember, ladies and gentlemen, your work as an actuary here is to estimate overally over the vesting period how many guys will be left. How many guys will be leaving for the 3-year period? Ndio ambao watabaki kwa kampuni. So this actuary sat down and he has been able to see that 20 have left in this year, and then a further 40 will be leaving. For me, you know, I'm trying to make estimates here. I'm trying to estimate how many guys will be left overall to take benefit of these shares we are promising them, or share acquisition rights we're promising them. So the language here, further, you must always deduct. So in this case here, and a further 40 will leave in the other years. So in this case here, 300 minus 20 who have left, minus the ones you are estimating to leave. So that by the end of this year, I should be able to know how many guys will be able to stay behind. Quite confusing. So we go to 2022. So 2022, what do we have here in 2022? In 2022, we are beginning with 300, remember. But you're told that during 2022, 10 employees are doing what here? Are leaving. And then the entity estimates that a further 20 will leave in 2023. But remember, these are 10 employees leaving in 22, and the 20 will leave in 23. But you see, we want the total number of employees who will leave in 3 years. Total number of employees who will leave in 3 years. Fortunately, we are quite aware that you have told us 2022 how many will leave. You've told us in this case here in 2023 how many will leave. And fortunately, we know how many left us in 2021. We know that 20 guys left us in 2021. So basically, when we are in 2022, ladies and gentlemen, we know that there are these 20 guys who actually left here. And then in the year 2022, we know the exact number of guys who are going to leave us in 2022. And then 2023, which is ahead of us, we are able to get the estimate. A father, read this thing again. Read this thing again. Read this thing again. So natuambia hapa, during 2022, 10 employees leave. The entity estimates that a further 20 will leave during 2023. A further. So for me, I would want to be left in this particular year alone. I just want to know how many guys will be left here 2022 from the 300. So 300 minus 20 minus 10 minus a further 20. Here in anga shida, here only period yama actuals. 2023 period yama actuals. So we know that 20 actually left in 2021. 2022 we had 20 actually leaving, and then this 2023 they have given us the actual that left. The actual that left. What have they told us in 2023? During 2023, exactly 10 left. 10 left. 10 left. So could you kindly give me these numbers? Give me these numbers. Give me the numbers. So 2021, what do we have there? So when they give you actual, and then they tell you further, you must deduct. You must deduct actual left minus the further. Further means more to leave, more to leave. In 2020, is it 2020, Ellen? Or 2021? The 40 estimate. Okay, 2022, only 10 left. Let me check here. Great question. Great questions are coming here. So we are told here, on 1st January 2020, of course, Akuna 2021. Akuna 2020, I mean, 2021. On 1st January 2021, the entity grants 100 share acquisition rights to each of its 300 employees on condition that they continue to work for the entity until 31st December 2023. During 2021, 20 employees leave. The entity estimates that a further 40 will leave. So then what will we do? As an actuary, I will look at it this way. I have 300 guys at the beginning, and 20 have left. 20 have left. And then I expect 40 to leave in the future. So I'm trying to make my estimates here. So in 2021, ladies and gentlemen, what I will do, I'll subtract the guys who have actually left minus, in this case, the guys I expect they will leave in future. So that I can know exactly then, at the end of 2021, because I'm trying to provide for an obligation in my balance sheet. As at the end of 2021, how many guys do I project to stay behind? So then this is okay. Now, so which gives me what answer here? I'm being told. The first one I'm being told is 240. Let's first of all clear with this. Ellen, I'm here to understand your question. Please go to 2022. 2022, then what do we have here in 2022? In 2022. Because Ellen is asking here, why do we not subtract? Why haven't we minus the 40 estimate? But Ellen, check, unless my handwriting is the one that is very poor. Ellen, check here. In 2021, I've subtracted the estimate. Oh, okay, then that is very good. I know. You know, if, for example, they told us that 40 is the total estimated. If they told us that 40 is the total estimated, then this 20 would have been in it. But you see, they're talking of what here? A further 40 to leave. Further means what here? That this 20 is not well within this. A further, additional. Okay, so please go to 2022 now. So in 2022, what have they told us? During 2022, 10 employees leave. The entity estimates that a further 20 will leave during 23. So it means that these 300 that I started with, I should be able to subtract these exact guys who leave in 2021 too, minus this further 20. But remember, if you do that, you'll have accounted for how many years? You'll have accounted only for 2 years like that. All right. And yet you're supposed to account for how many years? For 3 years. So it means, ladies and gentlemen, that I must come back here and subtract this actual here for 2021. The same. So of course, as we progress, you guys will be able to appreciate here. So can you kindly give me these other 2 answers? Give me these other 2 answers, and please feel free to ask questions. $250. So here I'm being given 250. 250. How about the last one? 2023. 2023 should be 300. minus 20 minus 10 minus 10. Let's see. 300. Ah, yes. 300 minus 20 that actually left us in 2021. Minus 10 that actually left us in 2022. 2022, remember the year 2023, we are working with the actuals that left us, actuals. So we are told here 20 actual left us in 21, 10 actual left us in 22, and then 10 actual left us in 2023. So you should have it this way, which will give me what number somebody here. In 2022, why are we not subtracting the 40 in 2021? Great questions there. I'll answer 260. You see, as an actuary, when you come to 2021, you're working on the things now which are on the ground. You must keep on, in this case here, making estimates. As an actuary, you must keep on making estimates. These guys here will leave. So when you come to 2022 here, check here, 2022, check here, 2022. What have they told us in 2022? You see, we start from the beginning of 2021. During 2021, 20 employees leave. The entity estimates that a further 40 will leave. You know, it's an estimate. 40 will leave during 2022 and 2023. So then that one I'll be able to make an adjustment. In 2021, I will say minus 20 here, minus this further that will leave in the future. Then we go to 2022. Things are different now there. So in 2022, what have they told us in 2022? So in 2022, they have told us during 2022, 10 employees leave. And then we come and estimate afresh how many guys will leave in the future. The entity estimates that a further 20 will leave during. So this other estimate that we had up there is irrelevant. The 40 estimate will be irrelevant in the year 2022 like that. Ladies and gentlemen, how many share appreciation rights have we promised these guys? We have promised them 100 each one of them. You have promised them 100 each one of them. Do we know their prices? Remember now here, the price for each will fluctuate because this is a cash-based. So do we know their price at the end of each year? Do we know their prices at the end of each year? The prices at the end of each year, they have been given to us here, the fair value at the reporting date of each year, 10, 12, and 15. So we have here 10, 12, and 15. We must always prorate this with the number of years. Remember, they gave us how many years? They gave us 3 years. So the first one will be times a third, times 2/3, times 3/3. So could you kindly give me these figures? I'm so sure once I do the last example, this concept of number of employees left behind will be a non-issue. So is there somebody who can give us these figures pretty fast? So we have in this case here 80,000. So we have 80,000. How about the second one? The second one, I'm being given a figure of 200,000. How about the last one now? How about the last one? The last one will be 390,000. So from there, so this is other components of equity in the statement of financial position. And we have in this case here our P&L, staff expense. So of course we're starting from 0. So we move, this is 80,000. The increase here will be 120,000. The increase here will be 190,000. If you wish to come and write them nicely down there as extracts, you are free to do that. Great. Great. So then you can see, ladies and gentlemen, from this, although it's poorly arranged, you can see from this. So like the expense here, the first one poorly arranged should be 80. The second one should be 120. And then you can see the last one is 100 what here, 90 like that. 190 like that. So that is it. 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 Our session will end there. Our session will end there. So we're going to introduce a third session, and it cannot be on Sunday. The third session